Thank you. Thank you very much. Actually, it's 4,000 one-pound jars of honey. I've got 100 hives. It's a way overgrown hobby. I never sell any. We give it all away. If I ever sold any, I'd make myself cry because I'd have to start keeping the books, and I'd find out my time was worth $1 an hour with a minus sign in front of it. It's very labor-intensive. Well, we're all here to try to look at the economic outlook. And if you look at, sorry, move back to one. If you look at what bonds are saying, bonds are telling you that the economy is weakening, that there's a recession ahead. You've had this gigantic decline in interest rates, and of course it's accelerated in the last 2 weeks. But if you look at stocks until recently, they're telling you quite the opposite, that the economy is in great shape, the expansion will continue, and more importantly, that the Fed will take care of any problems. And I think that's one of the basic problems with investors. You had, since March of 2009, that long bull market that was really fueled by Fed money. First they cut rates to zero, and then all the quantitative easing, dumping money out of helicopters, airplanes, whatever vehicle you want to figure. And it didn't go into spending and lending, investing. It went into stocks. And so investors now are in a position where they sort of say they don't care about anything else except the Fed. Who ever cares about anything else except the Fed? Anybody? No. You attended my master class today, maybe. Okay. But the whole idea, I mean, you see these really are things. You get a lousy economic report and stocks go up. Why? Because the Fed is going to come in and bail things out. But I happen to think that we are in or close to a recession. Now, they never ring a bell when a recession starts. As a matter of fact, you never know where you were until much, much later for a couple of reasons. One is the body that calls recessions, the National Bureau of Economic Research, a private body, and by the way, no government would ever want to be in the job of saying we're in a recession. These are guys that studied economic cycles back in the 1930s, and they're the ones that make the call. And they wait till all the evidence is in. As a matter of fact, the Great Recession, it started in December of 2007, but they didn't say it started until November of 2008, 11 months later. So it's a long time. And the other thing that happens is that you get revisions. And revisions are very important, and actually they are a very good leading indicator. You notice here employment. The revisions, the black bars are the first number, and then the second one, the blue bar, is 1 month later. And in January and February they were up. But starting in March, and every month subsequently they've been down. And that's what happens at peaks. You get downward revisions, and the reverse is true at troughs. You get revisions up. There are other indication, and our monthly newsletter we talk about all these. I'm just picking out a few. But you see the interesting pattern of personal income outlays and saving. There you see the blue bars, which are income, after-tax income. And you notice that up until recently, they were not rising as fast as the black bars, spending. People were spending at a greater rate than their incomes, so the saving rate came down, the black line. Well, then they got religion, and recently it's been the reverse, that spending is growing more slowly than incomes. People are rebuilding their saving. Another measure is the probability of a recession is measured by two of the Federal Reserve banks, New York and Cleveland, and you can see there that those have risen to recession levels. The recessions are the shaded bars in the past. Another one that's gotten a lot of attention today, and readers of our monthly newsletter Insight have known we've been talking about this for at least a year, is the Treasury yield curve. And when it inverts, which means that in this case, 2-year yields are below 10-year yields on Treasury notes, you've always had a recession. No exception in the post-war period. Now, why is that? Well, what happens is that investors, longer-term investors, start to sense the economy is weakening, there's a recession. That's a situation where inflation comes down, people run to Treasuries for safety, there's not a lot of other borrowing, and so they push yields down on the longer end. But the Fed is not quite so sure, and so they hold up short rates and the 2-year is much more attuned to what the Fed is doing and their overnight Fed funds rate. So it's only after the Fed starts to cut rates that the yield curve then reinverts and short rates drop below long rates. Another indicator here is the OECD leading indicators. These are the 32 largest nations in the world, and this is a leading indicator, and you can see that's in negative territory. Now, if we do have this recession, and I think we're already in it, and we won't know for months, nobody rings the bell, but you say, what's the length? What's the depth? Well, I think it'll probably be about our average recession. It could be worse. Now, here's a table of all the recessions in the post-World War period. You can see the start and ending dates, the declines in real inflation-adjusted GDP, and then the related declines in the S&P 500, measure of the whole world stock market. Now, there are three of these that I want to pull out because they really were sort of non-average. One was the early 70s. I talked about that in a master class this morning. That was a huge inventory building cycle. People thought inflation would last forever. They doubled and tripled inventories, and then all the inventories arrived. They had to cut production, cut sales, and you can see real GNP declined 3.1%, and stocks fell 48%. That was unusual. You had two other kind of out of the box periods. One was the 01 recession, a brief recession, very small decline in real GDP, but that was the dot-com collapse. And S&P went down 40%, but the NASDAQ went down 78%. And then, of course, the most recent one, the subprime-related Great Recession, 4.2% decline in real GDP, 57% decline in the S&P. Now, if you throw those out and look what's left, and you assume that this will be a run-of-the-mill recession, then you'd expect real GDP to decline about 1.5% to 2%, and for it to last about 3/4. So if it started earlier this year, it would run through roughly the end of the year, early next year. Well, what about stocks? Well, if you take out those three exceptions, the average decline, and these are just numbers, I mean, forecasting stocks with precision, if you're nutty enough to try it, you're either nuttier or smarter than I am. But the average decline was 22%. Now, it was down almost 20% October 3rd to Christmas Eve. 20%, but it's going to new highs. The S&P, if you decline 22%, it would take you slightly below the lows of December 24th. So you can say, well, been there, not that bad. But the risks are on the downside, and I think the risks are principally from trade wars. Now, here's the situation. Globalization, probably the greatest event on the international scene in the last 3 decades. And by that, I'm talking about moving of manufacturing from North America and Europe to China and other Asian lands. You took Western technology and applied cheap Oriental labor, and of course those goods were then were exported back to the US, but the jobs had left. And you can see there, the red line, the collapse in employment in manufacturing. Well, that really created a lot of problems because you had virtually no growth in purchasing power in any of the G7 countries, Canada, US, Germany, France, Italy, Japan, and the UK. You've had none for over a decade. And people are really mad as hell. Anybody remember the movie Network? Yeah, the guy Howard Beale, and he jumps out of his chair, and I'm mad as hell, I'm not going to take it anymore. Well, that's the way voters have been. So what have they done? They have rejected the politicians in the center, and they've gone to the extreme right and the far left. And I think that one of the things that's resulted in Brexit, resulted in this Italian government, where it's been a combination of far right and far left. Only Italians can do that. And I think it's what got Trump elected. And Trump, of course, really blamed this whole thing of lack of income growth on immigration and imports. Well, it's not quite that simple, but there's no question that imports have been in. Actually, you've seen the huge increase in our trade deficits. The numbers going down, the blue bars are increasing. And that has been particularly a problem with China, where the trade deficits are huge and increasing. Now, when you talk about this trade war, and we've been talking about a trade war for over a year, and people said, if we have a trade war, we've been in a trade war. It's just a current question of intensity, but now it is getting intense. I think the U.S. is going to win for one simple reason. When you have a world of excess supplies of goods and services, who's got the upper hand, the buyer or the seller? It's the buyer. We're the buyer. And besides, where else would China sell all those consumer goods except to U.S. households? So I think we will win. It doesn't mean it's easy, and it's probably going to be a matter of short-term pain to get long-term gain. There are time limits on this whole thing, and I'm making a really off-the-wall forecast by saying we may see some deal in the next 6 months or so. Why do I say that? Because Trump is facing the 2020 election. And the longer this thing goes on, the deeper the recession, and it's very hard for any incumbent to get reelected in a recession. So he's got pressure on him. At the same time, Xi, who's basically the president for life in China, has pressure. The Chinese economy is weakening. There's a lot of reasons for that, but and those numbers are probably about twice reality. They overstate their numbers, and even more so when things are weak. The guys in the provinces want to let the guys in Beijing know that things aren't really all that bad, otherwise they end up in jail. So they inflate the numbers more than usual. And their growth is probably not 2% as they recorded in the second quarter, but probably about half of that. Also, China faces a considerable problem. We looked at this in detail in our monthly newsletter for July, and I have a few copies if anybody's interested. But it's what's really happening in terms of transferring upscale manufacturing, electronic manufacturing out of China to Vietnam, to India, to Bangladesh, to all these other countries in Southeast Asia. And what they're doing is American and Chinese producers, they're saying, hey, let's get out of the line of fire. Let's get out of China and we'll move to these other areas where labor in some places is even cheaper. And they got to reorient their supply lines. But the thing the reality is, and the Chinese realize, is that once you move, you're not going to come back. You don't just unbolt the machine, take it there, and bring it back. No, you've got to build all the supply lines. So that's going to last. That's going to last for some time. Now, of course, in this trade war, China can't match us for dollar in terms of tariffs, because we import $540 billion from them. We did last year, and they only import $120 billion. So we basically, Trump is now off and on, but we're basically putting tariffs on everything we import. They're on everything they do, but they can't match us. So they're moving to other things. And one of them, of course, is to devalue their currency. In other words, to make their exports cheaper. And they have broken this 7 yuan to the dollar. It really could move from there. So I think that we're going to win this trade war. Now, there's a deeper issue here. And it basically is that China wants to be the top dog in the world. And the way they can get there now, the export game is over. They built a lot of infrastructure, which kept people employed, but it resulted in ghost cities and excess capacity and huge debts to finance it. So now they want to grow domestically. But to do that, they need Western technology. They are going to, for the next 3 decades, going to have a declining workforce. Why? Pardon me? Yeah, 1 child per couple. And even now that they're allowed more, they're not having them. So they need productivity, and the way you get productivity is technology, and they are not developing it fast enough to do the job, so they want Western technology. So that's where I think the big battle is going to be, well beyond the trade war. And Trump realizes this, and I think other people do this in Washington. So I think that's where this stands. And this is the thing that could very well turn a normal recession into something much more severe. Now, let me skip over a few slides here and just move to our investment strategy. And let me say that we're top down. We start with the political, the economic, the financial spheres, develop a forecast, and see what investment themes fall out of that. And then we apply them. We use stocks, bonds, currencies, commodities, futures. We range the whole thing. Our objective is to make money for our clients. And we apply this in 3 ways. One is with consulting with major financial institutions. Bruce Johnstone, who was here earlier at Fidelity, he's one of our clients, for example. Then we also publish this newsletter, which I mentioned. I have some copies and also information sheet if anybody's interested in looking at, subscribing to it. And we also eat our own cooking. We manage money, and it is done on the basis of our themes. And I'll tell you, I think that is I think it keeps me on the straight and narrow, because when I go in and talk to a client and I suggest investment strategies, they know that it's my money, my wife's money, my kids' money, my family foundation's money, as well as a lot of outside clients' money that is invested in those themes. So this isn't just some economist throwing out wild ideas. These are things that we're eating our own cooking. But I will say before I go on here that I always constantly remind myself that regardless of how sound our themes are, that markets can remain irrational a lot longer when we can remain solvent. So you have to be careful. Okay, now let's look at these themes. Just list them here and then I'll talk about them in a little more detail. Long Treasury bonds, that's been my favorite since 1981. I'll go into more detail on that. Long the dollar. The dollar is a safe haven. That's where people go in times of stress. Short commodities, I'll be through in a couple minutes. Everybody else ran over, I will too. Long defensive stocks. These are an anchor to windward, things that people buy regardless, and heavy cash positions. Now, if you look at Treasuries, what's going on here? Did somebody cut me off? May I have the next slide? Now, I want to go ahead. Oh, wait, I'll go back here. Okay, the key to interest rates is inflation. There's a 60% correlation between long-term Treasury yields and inflation. If you're right on inflation, you got a leg up on Treasuries. And inflation is cooling. You can see there CPI and PPI. Here's what's happening to consumers' inflationary expectations. They are cooling off rapidly. And government bonds, 20% of global bonds now are negative yields. And by the way, somebody said, who would buy a German bond with a negative 5% yield? You'd buy it if you thought it was going to a minus 1% yield, because then you get appreciation. And that's the only reason I've ever bought Treasuries, is for appreciation. I couldn't care less what the yield is as long as it's going down, because when the yield goes down, what happens to the price? It goes up. I buy it for the same reason most people buy stocks, appreciation. You've also had buying by banks and individuals in this country and foreigners. You look at the yield spreads here, the right column, where our yields, their yields are distinctly below ours. So there's an advantage in buying Treasuries, and also with the dollar appreciating, they get a currency translation gain as well. And this is my all-time favorite chart, stock and bond position, because it is really what happened. In 1981, I decided that inflation was unwinding, and therefore we were going to see what I said was the bond rally of a lifetime. And I participated in this both as a forecaster, as an investor, and for the family. And on the basis of this one investment, long Treasury bonds, the Shilling family achieved financial independence. This was 81 by the mid-80s. And just to show you here, this shows what happens if you bought Treasuries in zero bond form in October 1981 at their low in price, high in yield, 14.6% yield, and compare that with buying stocks at their bottom in July of 1982, and the Treasuries have outperformed the S&P, and that's with dividends, by 6 times since then. And I assure you that long Treasuries are only suitable for little old ladies and orphans. Well, the time is up. I'm getting all kinds of signals here, but let me just say, I hope that this forecast doesn't end up like a sign I saw in a men's room in London, because this was a machine in there. It was dispensing prophylactics, and across the top it said, made in strict accordance with British standards, and across the bottom somebody had scrawled in pencil, so was the Titanic.